Hello, and just to be clear, in general, I don't know what I'm talking about, so do your own due diligence. That being said, I think this is some of the most interesting stuff that I've come across since I've started digging into the world of options. So yeah, stay tuned. Really looking forward to the comments. Looking forward to trading this concept. Anyway, this is a plot of the implied volatility of at the money calls on SPY as you vary days to expiration. So typically, IV drops as the option approaches expiration. This makes sense because the stock has less time to do something crazy in a few days, so people don't pay a premium for a short-dated call. Sometimes, though, the markets get nervous. IV rises across the board, and the short-dated options actually rise proportionally more than the long-dated option. And the slope of the IV curve tends to flatten out, like you see here. So when the markets go into a panic, IV rises even more across the board. And this plot was made only 8 days after the first one, so this can happen pretty fast. But it usually goes from the typical scenario to the nervous into the panic. It doesn't usually jump from typical to panic. In any event, notice how the short-dated IV has exploded by a factor of 3x. This scenario doesn't happen often, but it's very materially impactful for the value of options, particularly short-dated options. So here are these IV curves plotted for 131 days of data. So 131 curves plotted on top of each other. It's easy to see that there are many more lines in the typical scenario than the nervous or panic scenario. So I wanted an easy way to distinguish between the scenarios. So rather than doing a fancy curve fit, I just take the difference between the IV at 40 days to expiration and 10 days to get the quote slope of the IV curve for each date. So for each of the 131 IV curves, I measure the slope value by taking the difference between the 40 days and 10-day IV. So this is a histogram of those slope values. So typically the IV at 40 days is greater than the IV at 10 days. So that slope value is positive. And you can see the histogram has a peak at about 0.03. So if you use your imagination, you could actually kind of see three histograms superposed. It's almost like the market doesn't operate on a continuum. It seems to flip from one discrete mode to another. So if I had more data, I might see a trimodal distribution, maybe. Anyway, I drew some dividing lines that sort a day's IV slope into its class. So anything with a slope of less than minus 0.01, I define as a panic class. Anything with a slope greater than 0.01 is typical class, and anything in between is nervous class. The red dots on this plot represent which IV slope class we are in on a given date. So you can see that on most days, the IV slope is in the typical class, and it stays there for long periods of time. So before it switches to panic class, the IV slope is typically already in the nervous class. So you have some warning before the IV flips from typical to panic, which is good. So the nice quiet times where the market is just marching dumbly upward is in typical class, and it's for 20 or 30 days in a row. So nervous and panic classes correspond to times of higher price volatility, as you can see here. So let's gather statistics on the daily return of the SPY when the IV slope is in the typical class. So that means that the short-dated IV is less than the long-dated IV. So the IV slope was in the typical class 68% of the time. And on those days, you had a mean daily return on the SPY of 63 cents. So if you multiply 63 cents per day by 88 days, that's a cumulative return of $55.44. So here's the daily SPY returns when the IV slope is in nervous mode, which is 24% of the time. We have a mean daily return of minus 32 cents and a much higher standard deviation. So the volatility is indeed higher during these times. A 32-cent loss per day for 31 days is a cumulative loss of $9.92. So now let's look at the statistics of the IV slope in panic class, which occurs only 8% of the time. So the mean daily return on these days is minus $1.99 with an enormous standard deviation. So during these times, the market makes both big drops and rises. Still, on average, the minus $1.99 times 11 days represents a cumulative loss of $21.89. Okay, so now let's plot the daily SPY returns over time, but we'll color code them based on the IV slope class. It's kind of hard to make sense of this, but the next slide really brings it home. So if you integrate those curves in time, you get a cumulative return broken out by IV slope class. And the results are really clear. There's a huge advantage to not being long SPY when the IV slope is outside the typical class. Whether it's in nervous or a panic class, it doesn't matter. It sucks in both cases, but it's great when it's in the typical class. So to really hammer home the point, let's add the cumulative return of the SPY over those same 131 days. So if you were only in the market during times with a typical IV slope, you've doubled your gain over simply being long SPY the whole time. So this is a big deal. As I said, probably the most interesting thing I've come up with since I've been muddling through the difficult world of options. We should obviously be skeptical. You know, this is not a cultivated back test. This is a fairly general methodology applied blindly to the data. You could certainly argue that we don't have enough data. That's true. And that if the regime of the market changes from a dumb bull market like we're in now to something more typical, it could also hurt the method. But still, it's interesting. And also, the daily IV slope data is pulled from end-of-day data. So there's kind of an unanswered question of timing as to when you receive the information, and is it skewing the results. However, if you remember, the IV slope doesn't often flip between the classes. It tends to stay in one class for quite a while. So that means that if there's sort of a one-day error in timing, it might skew the results, but not materially. It's not going to turn the blue curve or the green curve into the yellow curve, that's for sure. So anyway, in a nutshell, how am I going to trade this? As far as I can tell, I'm simply going to have a net positive delta position during the typical IV slope class times. Probably a leap option. When the IV slope flips to nervous, that's my signal to sell, probably an in-the-money covered call to move the net delta, if not to zero, possibly towards zero. And you also, it just happens to be a great time to be selling calls. So that's a bonus. When the IV slope flips to panic, it's probably a good time to just sell the leap and switch over to a pure short option strategy. This is when Tasty Trade tells you to sell short strangles, and if you have the cojones to do it, it usually works out, but sometimes it doesn't. Anyway, in terms of selling that leap, the big increase in IV will boost the value of that leap that you're selling, even if the stock has dropped. So there's a bonus again to selling that leap that you purchased when it was probably cheap during a typical time, and selling it during panic move. So anyway, this stuff is fascinating. Maybe you don't think maybe this is elementary, and I'm just dense and haven't gotten it. But anyway, I'm going to start trading this. I already have actually. really look forward to your comments, and actually look forward to, you know, what are the blind spots here? You know, what are my philosophical blind spots in thinking that this is the bee's knees? Anyway, we'll see you next time.